All right. Happy Friday, everyone. Welcome to our personal finance learning session. Today we'll be talking about comprehensive financial planning and how you can create a basic plan for your family yourself. But first, I wanted to introduce myself. My name is Alex. I'm a startup founder. Before starting my company, I worked at Big Tech as a software engineer. Now I'm building a platform to democratize fiduciary financial advice, lower its cost, and help more people make better financial decisions. These learning sessions we organize for part of that effort. My co-founder, Simone, joined me today, and I wanted to introduce her first. Simone holds PhD in statistics from Purdue University. Previously, she worked at Goldman Sachs as a quant, helping mutual fund managers with portfolio construction and risk management. And before starting this company with me, she worked at Meta as an ML engineer. So Simone, how do you plan, how do financial plans help people? Why do we need to have them in the first place?
Yeah, so I think that's a good question. To me, I feel like with my background, as Alex just mentioned, we actually start our company thinking about working more on like a portfolio management, portfolio construction. And then we talk to more users, we realize that actually before the portfolio construction, we need to figure out what they really want, where they are in their life, like what's their incomes, expenses, build a financial projection, and then figure out financial goals before we can move to portfolio construction. So I think that's why one of the reason, one of the benefit of financial planning, it provides clarity. Recently, I've been talking to a lot of our users. I think a lot of them, they're at the stage to decide whether I should retire. I already have a certain amount of net worth accumulated, but I don't know if I can support my life. And that's the time when you do financial planning, make projections to figure out that clarity, because it's not like a straightforward one line. Like there is 4% rule, we all know that, but year over year, like your spending could be different, and that financial planning actually create the clarity so that you don't have surprises and you can plan ahead.
And quite often people start, from tax planning, right, or portfolio construction, and say, hey, can you look at my portfolio, or like I would like to optimize my taxes, right? But it's really hard to do that before we understand our financial goals, right? And the question is always, what are your financial goals, right? Okay, if you don't know that, I think we first need to take a step back and figure out that, because I don't think it's possible to do any tax planning, right, if you don't understand how your income and expenses will change over time, and what would be your tax rate in the future. And for that, we need to understand financial goals, we need to understand the projections and the current situation. So the right process, right, what we've been following is that going from left to right, starting with first understanding what are the current financial situation of the family first, and then going into building financial projections and financial goals.
Yeah, and different financial goals also have different time horizon. I feel like when I'm talking to users, a lot of time people would ask me in projection, like, oh, do you run simulation? And my first question is like, what type of portfolio are you running simulation with? That's why we actually move simulation to financial goals. That's when you actually know your time horizon, what's the successful rate you require, how important this goal is. All these factors come together before you can actually run simulation or build a portfolio.
Yeah. And today we want to talk and focus on financial projections, on this step, right? When we start adding future or expected income and expenses on the timeline and see how it will affect our net worth. There are a lot of steps here in this process, but today we'll just focus on building financial projections with you. And Simone, I wanted to ask you, what are there any problems that we notice that it comes also to projections? What are the typical topics that come to this conversation?
I think one thing I noticed when I talk to user is like we actually deliberately separate like current net worth and the income. That's what you happen right now, like what's your income. And then when I talk to user, immediately when they enter income or expenses, they will say, oh, this doesn't, like I have something coming like next year or another expense gonna come. That actually would be the future expenses. Like happens in projection. We want to take it slowly, step by step. You first understand what you are doing right now, and then you think more. We call it life events. Based on life events, maybe a life event would be, I want to support my kids' college. Kids' education is a life event that would have different expenses there. Or say I want to buy a new home, or I want to sell my home and buy a new one. That would be a life.
So you're saying that first figure out your current situation, right? What is your current net worth, assets, liabilities? What's your current income and expenses before going into the future? And it makes total sense. And what I've seen from my experience is that just entering the data, the current one, right? Like what are their accounts? What are their tax treatment? What are the current living expenses? There's a lot of options to enter the data incorrectly. And making sure first that we start here and verify the data. I think this is a very first important step before we start to project that into the future. Because if we don't understand, let's say, our current budget, right, and like our current expenses well, that may affect all other steps after that. Projections will be affected, financial goals will be affected, so portfolio construction, tax planning, so everything. So yeah, I think it's very important to take the first step right and enter the data correctly. I agree with that. And I created a few, I want us to discuss a few topics today, right? And that's from our experience that we've noticed. We built probably hundreds of projections for our users and reviewed projections with our users. And we noticed that there are some typical mistakes that people make there. And the first topic I want us to talk about is about the social security, Simone.
Yeah. So as you mentioned, like you see like many ways people can enter information wrong and make mistakes. What are the common mistakes you see here about Social Security?
I would say that the first is not taking Social Security into account and completely ignoring that. I think that is the first thing. Is that most of us who work for long enough, we qualify for Social Security, and that's might be significant payments in the future, up to like $30,000-$40,000 a year, and not taking that into account, in my view, is a mistake. Also, some people say that, oh, I don't want to rely on that. That might be a good conservative approach, but completely ignoring that, I think that would be a mistake. So quite often people just don't know that, hey, there's a Social Security and how it works, right? And there are many details there. But for people who know what is Social Security, and they know that there's a website, ssa.gov, provided by Social Security Administration, that they can go and get the estimate of the benefit. One of the common mistakes that I see is that when they go and fetch that PDF file, that is a screenshot is presented here on the top, and they say, oh, okay, if I retire at 62, so that's my benefit that is going to be. And many of them miss actually this thing that these projections assume that you will continue making that income until you retire. So that might be quite elevated because of that, especially for early retirees. Let's say if you're in your early 50s and you're looking to stop working earlier and you're creating your financial plan, you go to the ssa.gov and take that PDF file and enter this information. That might be elevated. What you would like to do instead is that on the same website, there's this chart where you can actually modify your future annual salary, and you can set it to the one that you expect is going to be. So if you continue working, so you can set it up. If you would like to switch to part-time work, so you can reduce that and adjust. And it will give you more accurate estimates in this case. I would say that that's one of the things that people miss. And that PDF file actually has a very clear message, but because there's a lot of text on that page, is that it might be, some people miss that. And they say that these personalized estimates are based on your earnings to date and assume that you will continue to earn until you start your benefit. So in this case, until you turn 62. So I think that's one of the important and most common mistake that we see when we review the data with our clients. That's one thing.
I think you mentioned a lot of people don't take Social Security into account, but is that guaranteed that I get Social Security?
That's a great question, right? I mean, we can't predict the future, right? But and there are concerns about the fund depletion, right, for Social Security. So for people who worried about that, especially I think maybe wealthy people, right? Because if Social Security will be affected. Maybe people with significant assets will be affected first. Maybe you can apply some discounts. And it's something that we sometimes do, right? If someone says that, hey, I'm not sure, I'm worried about the Social Security, or I don't want to rely on that too much, we can apply some discount. For instance, take this number that is provided by the website and say, okay, let's apply 50% discount, right? Be more conservative, or maybe 30% discount on that, right? And by that, we kind of rely less on Social Security. That might be one of the options for people who are not sure about the benefit in the future, might be.
I see. Is Social Security taxable?
So it's interesting about Social Security. It's actually another mistake that we often see, and I think I have a screenshot for that. Is that when people enter their benefit, they mark it as W-2 income quite often. It's a very common mistake. But the problem is that Social Security is taxed differently. It might be tax-free. It might be a tax up to 85% of the benefit, depending on the income. I mean, on the future income, right? And if you want to a more accurate estimate for like how it's going to be taxed, you would like to set it as a Social Security income type. So the model will look at your overall income that year, and it will understand how exactly it needs to be taxed, and it will apply the tax in the model. So just make sure that when you set it up, you set it not as a W-2 income, but as a Social Security income type.
How big a difference would you see, like if I said it wrong, like if this becomes W-2?
I mean, you pay high taxes, right? Because W-2 is 100% taxed. I think. Correct me if I'm wrong, because I don't remember on top of my head. FICA taxes, right, also apply for W-2 income, while it's not. I believe it's not applied for Social Security, but that's probably not my area of my expertise. So there is significant changes and differences, I would say, between our Social Security and regular W-2 income are taxed. Is there anything? Next thing I want to talk about, Simone, is medical expenses. It's actually a very big topic, right? And a lot of people, when they start planning their medical expenses or their retirement, medical expenses is one of the biggest topics, right? And concerns for them, because people think that expenses will go up significantly. Can you briefly talk about that? What are the common mistakes that maybe people make when they think, plan for medical expenses?
Yeah, sure. For me, I think similar to Social Security, I noticed like people don't usually think very carefully about their medical expenses. Like so far, I think I've been talking to all our basic plan users. I actually haven't seen anyone before, like we meet, actually manually add a medical expense, like before their retirement or after retirement to their financial planning. Like I feel like when people think about retirement, they start with what they currently spending, and then a lot of time they will miss some key component about this medical expense. To start with, like if you are say before 65, a lot of our users, they actually do fire way before 65, maybe around 50-ish. And between this time, you actually still need some sort of medical insurance to cover. And then I think there's different options. And one of this is like this ACA that's a lot of people have been talking about. And it seems like there's a policy change every year. And ACA itself is not like, it's a way relatively cheaper expense if you get that subsidized. If you don't get subsidized, it's still expensive. So that would be a big portion of the expense you would need to plan for. And
yeah, it's one of the things, right, that affect these discounts, right, that are provided by the government. They really depend on the income.
Yeah. I think ACA itself, like if we could have a session, we can discuss a lot about it. So to start with, like it depends on your taxable income, about how much you pay for ACA. And so if your taxable income is above 400% federal poverty level, currently for 2025, you will still enjoy some credit. You pay up to 8.5%. It's because there's some rule like called ACA extension, but that might change in 2026. So far, I haven't seen any news about they renew this extension. So very likely next year, if you're above 400% federal poverty level, you're gonna pay the full premium. That's a huge jump. And even if you're within that 400% federal poverty level, I think there's some like a bracket change, like you still pay a little bit higher.
Yeah, and that's, not all people realize, right? But when we start doing rough conversions, it actually increases the ACA premiums, right? So actually the problem that quite often we need to solve, right, is that how do we balance rough conversions and ACA premiums, right? Also, and take that into the account.
Like, I think that's a very good point. And you actually need to be very careful about this, like a calculation. I think what I see is people tend to underestimate their taxable income. To start with, like, I think we just cover the Social Security. It's taxed, I think, up to 80% maybe at federal level, and some target. But when it comes to ACA, you calculate this taxable income. Social Security is 100% taxable income. There is now the AGI that's used to calculate this premium. It's the MAGI. So there's certain adjustment you need to do. Social Security is one of it. Another one would be tax-exempt interest. So at federal level, if you have muni bond, it's not taxable. But when it comes to ACA, it becomes taxable. So if you're now careful with this, you put your, like, say, taxable income closer to the 400%, you may unfortunately go above that 40%. And there is actually this cliff. Once you go above 40%, if there's no that extension, you're gonna pay like the full premium.
Yeah, and there's another opposite problem. Families who don't have income at all, zero, right? They may not qualify for ACA because ACA requires the minimum income to be at 100% of PL, right? So for those families, Medi-Cal or Medicaid, that would be another option. Speaking of options, like what are other options that people can consider when buying coverage for themselves?
Before this, I actually want to dig in a little deeper about what you just said. Like some people may have that gap. What that gap is, like ACA only covers people who has like over 100% the federal poverty level, and below 100%, they are supposed to be covered by Medicare. Like I think there was an extension so that the Medicaid cover anyone who's below 138% of the federal poverty level, but some state didn't do this extension. So, for example, Florida or Texas. I remember back then there was a huge discussion that people fell into this gap would be no way to afford the medical insurance because they don't get any credit or any subsidies, and it's very unfortunate. So plan better for that. That's the part I talked about, making financial plan. No surprise, like try to get everything like clarified. And back to your question, what are the options? I think ACA would be the most reasonable option for most of the people, but there is like COBRA. Say if you are considering stop working right now and your current company has this insurance, you can continue with the same coverage for like up to 18 months. But this will be kind of expensive. You need to pay the full premium plus like some admission fee. But it's a good way to like temporarily get your coverage before you figure out the whole ACA.
Yeah, it really depends on the insurance that was provided by your employer. And also I wanted to mention that because we work with families with disabled family members, is that for disabled people, it extends to 29 months. So they get an additional 11 months of coverage on COBRA. And sometimes it makes sense to stay in COBRA. In some cases, it doesn't. It really depends on the personal situation. So for instance, we worked with a family when COBRA provided actually some specific coverage for one procedure, which wasn't provided by ACA. So they stayed on the COBRA just to get that access to that procedure because it was very expensive and it made a lot of sense to them. But other families, they may find that, yeah, COBRA is just too expensive and they don't really need that. They can just go directly to ACA in this case.
Right. And there's actually like another tier would be like just go to the private plan. Like ACA, the benefit is if you stay within 400% federal poverty level, you will have that credit. But like if say this extension doesn't happen, going forward you pay full premium, it may actually make more sense to look for some private plan. The private plan can be a little bit cheaper, but like it has narrower network. So depending on coverage, if you are absolutely not suitable for this subsidized, private plan is another option.
Yeah, but even on this ACA, right? I'm still on this presenting this screenshot, right? There are gold, silver, and bronze plans, so you can actually play with premium versus max out of pocket, right? And decide what's best for you. What is the difference? Do you know what's difference between gold, silver, and bronze? Like how does it work?
Like the level higher would have like a higher premium, but a better coverage, lower deductible. That's in general. And actually, this screenshot is what I did from this webpage. It's a Kaiser Family Foundation. They give you an estimate based on where you are, like what's your state, your zip code, and your family member, your age, your income. Like they gave you an estimate, like with premium, cover tax credit or without the credit, how much you will pay.
So you provide your expected income, right, for the family, who is on your family, what's their age, right, who needs coverage, and it gives you different options for ACA, right, and what's the premium cost and what is the max out of pocket, right, then they do. That makes sense. The way we've been approaching, and everyone is different, but the way I've been building financial projections is that we do it conservatively. So I always say that every year the family will be paying premium and max out of pocket, and it actually helps gain that confidence in the medical bills. So yeah, we know we are covered, we buy that coverage, but also we plan so that we will spend that a max out of pocket every year with that insurance.
Yeah, I think that's a very good way to start, like be conservative. Another factor I would point out is when I build projection, a lot of time we say, oh, expenses just match inflation. It seems reasonable, but when it comes to medical expense, it actually grow much faster than inflation. In the past few years, I think it's usually suggests to assume like 5 to 7% growth.
But don't you think that it might be not sustainable? Because let's say if we go for that like 5-7%, right, and you expand that for like 20-30 years, then it might just
it may blow up, right? But
exactly.
This is ACA, so here we're talking about like before you're 65. I think after 65, it's a slightly different. You go to Medicare, which is cheaper. But again, it's cheaper doesn't mean like you don't pay anything. You still need to plan for like out of pocket.
Yeah. And I want to say that when you build your financial projections, you actually want to be careful with these estimates. Like, hey, I'm going to set up like 10% annual increase. It's fine for a couple of years, probably, right? And especially if you have some insight into that. But try to be very careful with such assumptions when you plan for like 30 years, because it will just increase dramatically your expenses and make your plan unrealistic in this case.
Yeah, I completely agree. I think some people, they do like a couple years because I also see people when they plan, say, oh, I'm going to retire, and for the first couple years, I'm going to travel a lot. I may like increase some of my insurance because I'm travel and I need to get travel insurance. That's another thing. The good part is they actually keep in mind that there's some bump because they do travel, but like some people, it's better than like not aware that you may need to pay extra.
We briefly talked about ACA, Medicare, right, a little bit, COBRA. So is there anything else that we need to cover here? So,
we're not done yet. There's another piece, like if you go to the next slide, that's the long-term care.
Okay.
I think to me, long-term care is actually a significant amount that most people probably gonna use. So in our product, we force people to look at this by automatically add a long-term care. This is a screenshot about how much it's gonna cost. Like the cheaper version, that's community, where you're still like healthy, you can do most of the stuff yourself. It's like a $26,000. But if you look at all the other options, it's really expensive. And
I wanted to show the website that I've been personally using to do this estimates. It's called Care Scout. You can enter your location. Let's say, hey, I'm in California, for instance, and it can show you different options for the cost on long-term care. A couple of things I wanted to say about the long-term care is that, and it may help people plan better for that, is that almost nobody uses long-term care before 60 years old. It's really people use that service at the very end of their life for, on average, maybe 2-3 years, right, Simone?
Yeah.
We often plan it more conservatively. We say that, okay, let's go for 4 years, but no more than that. I saw projections when people were really concerned about their long-term care. So they set it up like, hey, I'm going to be on long-term care for 20 years. There's no way. I think it's very, very conservative and just misleading.
Yeah.
2-3 years, maybe 4 years at the end of the life. That's what you're looking for. What you would like to do is just to make sure that you plan for that and you pick an option that you think is right for you. One of the typical mistakes, and we saw that, and it's just hear these stories all the time when two partners, one of the partners goes on long-term care, and because the family didn't plan for that, they deplete the savings more than expected. So the second partner actually remains in some stress situation, so they have less savings. So that's something that you would like to plan for, and just make sure that you are prepared for these type of scenarios when you create your financial plan.
Another thing I want to bring up is like the long-term care. There's like insurance you can buy. I think a lot of people, what they choose is they have a insurance that cover the initial dollars, and if there's like more they need to do, they will do out of pocket, like a hybrid approach. Buy some insurance so they are kind of guaranteed, and then if you have more needs, like you pay out of pocket.
Insurance is a good option if the family is, on the board, right? They are on the board, they on the fence, and they don't have enough money savings. For people who have savings, I think self-insuring themselves is a better option in general. So we did analysis and we calculated that, okay, if I buy insurance today, right, and I pay for that, versus I self-insure myself, when I take the same exact payments, right, and put it into the market and invest it, especially in tax-advantaged accounts, the amount of service that I get is basically 2x more if I self-insure myself. But of course, that option may not work well for everyone. Let's say if a family is not great at saving and investing, then buying insurance might be a better option for them. But you need to keep in mind that all these insurance companies, their businesses, they want to have their cut. You're going to get more service or better quality if you self-insure yourself. And another thing, I also wanted to mention, we work with the client. There was a situation when one of the partners went on long-term care. They had insurance, but the family said, no, we don't want you to go to a hospital or some other, nursing home. We'll take care of you because we want you to stay, with us within the family like the last few years. So they didn't use that insurance because of that. So they paid all that time for that insurance, but they didn't use that. So another thing that you would like to think about when you plan for long-term care costs is that if you self-insure yourself, you get more flexibility, right? You can reuse the money and say, okay, we actually don't want, or we don't need that. We will use that for something else. Is there anything else that worth discussing and talking about long-term care, Simone?
Yeah, let me think about it. Maybe. Oh, there's one more thing. I think it come to my attention a few times. Like people care about IRMA. Like it's we talked about ACA, but when you come to Medicare, like if you're a high income family, you will need to pay for a premium on top of that, on top of the Medicare. So that's something pay attention to. Yeah, I think that's most of it. Oh, maybe one more thing. So we talk about ACA, Medicare, all of these, and we talk about out of pocket, but it doesn't cover dental, vision, and like some other things like acupuncture, like a chiropractic. If you have needs for that, that may be expensive as well. So don't ignore these expenses.
Yeah, and I guess it's going to be the same decision, right? Like with long-term care, you can either self-insure yourself when you allocate funds for your dental and vision needs, or you buy insurance for that, right? And you can make that decision. So different people have different preferences here. That's a good conversation. Yeah, so thanks for sharing that. The next thing I wanted to talk is about the typical mistakes that people make when they plan for living expenses. And the first thing is, I would say that what I see from my experience is that people don't separate different expenses with a different timeline. They say that, oh, my overall spending X $1,000, I'll just put it like it's going to be in the future. But the problem is that they have mortgage, they have maybe school expenses that will go away eventually. So when you create your financial plan, you would like actually to separate expenses with a different timeline. You don't want to go super detailed on that, but just separating that, it will already help you. And JP Morgan did a study. So they took the credit card data of their customers of JP Morgan Chase and analyzed how expenses change over time. And what they found is quite interesting is that they found that expenses normally decline over time, so and reduce. And so what they found, I just read some numbers for you, is that so for households, let's say here from with investable assets between $1 and $3 million, spending declines by 1.83% per year on average over years. And of course, there's a period when it slightly increases first because people start to travel, go out, do things that they always wanted to do, but they never had the time. But then over time, their spending reduces. And you'd like to take that into account when you plan and you try to figure out how much money you actually need for your retirement. What I found interesting, Simone, on this chart is that if you look at the housing expenses, right, it's a gray area here. It almost doesn't change, maybe just a little bit. So you see there is some reduction, right, in that, but not that much. Because when we look at financial projections of people who we work with, right, most of the time it's mortgage going into their retirement, right, and then stopping at some point. So what we see actually is that there is should be something like significant decline in that. Maybe that's because of different generation, maybe because most of these people already paid off their mortgage. So, but I found that it's quite interesting, and maybe that data might change for the next generations because now housing is less affordable.
And as I'm looking at this, I see that blue line, like that's charity and gift, right? And it feels like when people get over 85, most of this a little bit tilt up increase are coming from this charity gift.
I think it's the time. I'm glad that you pointed out, because from what I see, when people in their like 45, 50 years old, the main question is mostly, do I have enough, right? Am I not going to run out of money? So people focus it on that. But over time, if they spend well and they manage their portfolio well in retirement, they realize that actually there are 3 buckets in their for their money, right? It's money that they spend on themselves, money that they want to pass their heirs to their family, their legacy, and also money that they want to use in philanthropy, right, and give to make charitable donations. So that's a need that emerges once people start thinking more about their legacy, and then they realize that their own financial goals are met and they can achieve them. But it's normally not at the age like 45, 49, because there's a lot of uncertainty yet still.
Yeah, but I feel like that opens up another conversation. Like this charity and gift, it also include the part that you give to your child, right? And then like I think it's an argument that it works more like when you give to your child when they're younger, maybe at their 30s, when they're trying to build a family, get a house down payment to raise the kids. And when you're about 85, 90, your kids about 60, about to retire, they really don't need that money anymore. So if you plan ahead, like you realize that I will be doing well, and I have some money, maybe upload those upfront, the gift to the kids earlier than wait till the last moment.
Yeah, I think it's actually one of the very important things that the family needs to do, and that's the work that is better to do, is that understanding like what is their giving strategy, right, and how they want to support their families further. Because as you said, money that you give to your kids when they're in 30s is way more valuable than the money that they will receive in 70s or 60s. It's just impact is very, very different. So you may want to plan that ahead. And the best thing to do that is to figure out how much you need for your own retirement for your own needs. I think that's a good conversation.
That would be like an accurate financial projection, or like a relatively accurate financial projection to see this.
And normally when you, if you want to do, to pass money earlier, let's say, then it's a different tax planning, because that means that you might give a significant amount of money to your kids that might be trigger some, may or may not, right, trigger some taxes, because you might be taking money from your, let's say, taxable accounts that may have a different cost basis, and that may, or you maybe not selling, just not giving this money, I'm just transferring that. So you need to take all these estate taxes and give taxes into the account when you plan that. So
yeah, I think that's a very good point. When you do early, you need to plan better for tax, because like if you do it at the end of your life, then there will be step up like cost basis.
Yes.
Like it's also like some tax planning you can do on the other end.
Yes, and we can see here that healthcare expenses, they actually go up over time. So that's gut feeling that all of us have, that we're going to spend more money on healthcare in the future. That's correct over time. But you can see that I think it's a very valuable study, and I really like this diagram, because it really shows us like what is the percentage of the annual budget, right, each of the category is going to have. But again, I think that for many families who have mortgage today, many are going to have higher, probably housing and mortgage expenses in the future. That's my suspicion.
Yeah, I think Vivek just asked a question. To know if this includes tax, it'd be useful to know like this is in the context of pre-tax or post-tax.
So they analyzed credit card data, right, or debit card data. So it was already money that they spent. So I think you asked a very good question, that because if you want to spend this amount of money, you also need to add tax provisioning, right? Because you will be taking money from your, let's say, taxable or tax deferred accounts. So, and this money is not here. So, but you will need to include that withdrawals. But this study just shows the credit card data usage. So I don't think it takes that capital gain taxes into the account. All right. So maybe we should talk about. One more thing about living expenses. There's a very nice website that I've been using a lot when creating financial projections. It's called Living Wage MIT Edu. And you can enter your zip code or zip code of the place where you think you will retire, and it will give you a cost of living for that area for different families. And you can actually, using that table, you can get a lot of insights. For instance, how much it costs to have a child, right? For instance, if a family has one child, you can use that information or data to calculate what it costs actually to go to two children in the family, and calculate that increase in spending for you, and use that in your projection. For instance, if you are a young family, you are still planning to have kids, that might be a good data. Or if you want to retire in a different place, let's say you currently live in a high-cost area, you are thinking about moving somewhere else, that's a good website that you can use to estimate your future living expenses.
I see it's very detailed about food, childcare, medical, and like, do you recommend like when we do planning, like be at this granular or like more granularity or lower granularity?
I normally, when I build financial projections for our clients, I separate things that have a different timeline. For instance, childcare, I exclude that, right? Housing, normally I exclude that. I have a separate life event for the house, because sometimes people say, I'm going to sell that house in 5 years, move somewhere else. And we take that into the account. So we create that event for that. And annual taxes, we calculate it ourselves, because this is just overall, average estimates. We do it the tool does that automatically. So we often take this data from this website and separate some of the expenses and sometimes combine it together. So we discuss it with the clients how they prefer to have this projection built. So yeah, I also want to talk about home ownership, Simone. So I think it's a big topic, right? And a big expense moving forward. What are the typical mistakes like people make when they think about their future home expenses and when they build their financial projection?
Yeah, I think we briefly covered that. We see that the mortgage and home owning expense is stay relatively stable in the previous slides. But here's a few things I noticed. When I talk to users, when they talk about home ownership, their first come to mind would be mortgage. But mortgage is actually only fixed amount of time, like 30 years. Maybe you are already 5-10 years into your mortgage or almost paid off. But what actually has this long-lasting effect will be your property tax, HOA. That actually takes all the years until end of the projection. I think that actually has a bigger effect than the mortgage itself.
Yeah, and for people in California, I don't know if it's here. Quite often, I see that people set home property increase too much inflation. While in California, there is a cap, right, for the property taxes. It cannot grow more than 2%. This is minor, but it's worth checking also in your projection. What do you think about the home maintenance? I think it's...
I think that's one thing I want to mention. A lot of time on a regular basis, we don't spend a lot on maintenance. When I talk to people, they're like, I don't know, it's a small amount. But it's only a small amount until 1 year you need to replace your roof or have a big renovation, redo your yard. That kind of expense actually would be a one-time big expense. And I want to bring up that you don't want to have that chain effect that, this year I have to do my roof and I don't have a buffer of fund there. I need to maybe withdraw from my taxable account that I need to pay a lot of capital gain tax, or withdraw from my 401k account that I need to pay income tax. Remember,
how do you think people need to think about how maintenance expenses? How should they plan for them?
Yeah, exactly. So remember, previously we mentioned that you need to be careful plan for your ACA or income, for IRMA. You don't want to be I trigger more taxable income and eventually my house insurance also gets bumped up because of my taxable income get bumped. So plan ahead. In my way would be I allocate a certain amount every year, maybe build a buffer, an emergency fund. These are different options that you can account for the one-time expense.
Yeah, I found that following 1% rule is a good starting point, which says that on average, of course, it depends on house, when it was built, but planning for 1% and 1.5% of the house price is a good starting point.
Yeah.
In that. And when I learned about that, I was quite surprised. So it's because some people might say, "Oh, that's pretty high, right?"
Yeah.
1% every year. But then I did my analysis and I took all these major expenses, look up what is the price, how much it costs, right? So for instance, roof, $2,000, $20,000. Sorry, I said it wrong. $20,000. Painting $14,000. And you do that maybe every 10, 12 years, right, for different expenses. Floors, foundation, $30,000. Structural issues, $20,000 every 30 years. Tree removal, $5 every 30 years. So if you start adding these things and how often they happen, you will actually arrive to that 1.5% very, very quickly. Of course, you like to take into account your house state, right? It might be new house, so at the beginning it might be lower expenses, but 1.5% is a good starting point when you create your financial plan.
Yeah. And in another word, home ownership is not cheap. In general, you have to plan better. Yeah. And we also have different videos about whether you should buy or rent. That's a separate topic. But the key takeaway is like home ownership also takes money to maintain it.
That's true. And we were able to see that when we separated the life events, right, in our tool.
Yeah.
And now we can see, okay, this pink one is owning a house, right? And we can actually can see how much, it takes, right, for the family. And you can disable and see, okay, this is what's the impact, right, on the net worth. Now it's like $33 million, right, at the end of the plan. And if I enable all these expenses, I go to something like $22 million at the end of the plan. So it's a big difference, actually.
Since you're on this page, I also want to mention something different. It's not about this topic, but can you click today dollar? One thing, like when I'm helping people review the projection, is this today dollar really helps, because like with inflation, if you're planning for 30, 50 years, the net worth amount is just unrecognizable. Like 35 million, it sounds huge in today's value, but actually if you adjust for buying power, it's about like how much?
It's a $4.6 million.
$4.6 million. So I think it makes a lot more sense. Like when you're planning, take a look at today's buying power.
Yeah, and I think you'll like to see both numbers because today dollars, it helps you understand what lifestyle you'll be able to afford with your portfolio. But actual dollars or nominal dollars, they prepare you for inflation. Because when we go and look then at, let's say, our budget, right, annual budget, we see that all these numbers are much higher than today. And you mentally can, when you see these numbers, you're mentally prepared that, okay, I'm going to pay way more for my expenses in the future because of the inflation. And you see that, yes, your plan works well, so your net worth is still growing, so you're fine despite that inflation. So you'd like to see both of them, actual dollars and today dollars, in my view. We have maybe just 8 minutes left, and let's see if there are any questions that people may have so far. Feel free to just raise your hand if you have any questions, or I'll leave your question in the chat. We'll be glad to answer that. And maybe we should pause a little bit, right? So to let people
let people think about it. But I just noticed like there's another bullet point I want to quickly mention, that people sometimes consider like a downgrade their house when the kids are gone and they don't need a big house. You need to plan for the selling cost, also the capital gain tax that incurred if your house has like significant appreciated the value.
Yeah, we have some projection example of the projection, right? Let's say a family wants to own a house, like they want to buy it in the future, own it for 10 years, and then sell it. And the model, so you can see that all the cash flow associated with that are added, so that they can understand what is the impact of that, and then they can see in the projections these spikes, right? These two spikes in the taxes. That's when they buy the house because they're taking money from their savings to pay for the down payment. And then when they will sell the house, because it will appreciate, they will also pay more taxes that year. So that actually understanding that situation actually helps them plan better and do that tax planning, right? So that's a very good point, Simone. At the end, I want to quickly talk about the common misconceptions and challenges, the common mistakes that people make when I review the projections. Quite often, I see unrealistic expectations. For instance, people assume that their income will be growing 10% a year for 20 years. For instance, it's not sustainable. Or they think, because they see that, long-term care cost has been, growing 10%, right, for the last couple of years. I would like to use this 10% in my projection, and I assume that it will grow 10% for 30 years. Now, that creates very unrealistic projections in this case. So just be careful with that.
Question here. Aaron is asking, any thought on how long-term financial planning can be modeled to account for near-term expense expected due to aging parents?
So, Alan, I think it's a great question, right? So, and if you say have parents that you would like to take care of, you can create a separate life event and say, hey, I would like to have a parent support, and this is how much I plan to send them, right, or spend on that. So you estimate its expenses, you create that life event, in the tool, and you can see how it will affect basically your finances moving forward, right? So you can enable that and disable and see what's the impact of that and how to prepare the money. So and then in your annual budget, you can see that, oh, I have like also parent support here, and I need to reserve money for that. So this is how you would like to plan. Does it answer your question? Okay, wonderful. So one more thing, so we talked about realistic assumptions. I encourage you to be careful with inflation assumptions. Go check the historical data. Don't, if you're worried about inflation, try to avoid numbers like 10, 12% that we sometimes see in the media, right, as a shocking news. Try to be more conservative and look at the historical long-term data. The same applies for portfolio growth rate. You might see that historically it's been 10%, and maybe your portfolio has been doing really well recently in the last few years, growing like maybe 15, even 20% if it's a risky stock. Try to avoid using that in long-term projections, because you better to be more conservative when you plan so that you're ready for the worst scenarios. And one more misconception, I think it's something that very few people also realize, is that their taxes are going to change over time. So when we work in our active years, we pay a lot in taxes. But when we stop working, actually our taxes drop because our income drops. But at some point, let's say here for the family, they start using their tax deferred accounts, which are taxed differently. So the taxes then increase again in the future. So just keep in mind that taxes that you pay in the future, they're going to go up and down quite often. And especially if you have some interesting expenses, like you would like to buy a house or you'd like to sell property, then you might see some spikes in the future, like here on your taxes. I would like to pause here. And Simone, is there anything that you want to add on this topic of financial projections and typical common misconceptions?
I think the tax one is really it's actually sometimes a big chunk of the expense. Like even though we say there's medical expense, living expense, tax is also part of it. So when you're planning, that's important to take into account.
I want to just reiterate and say that one more time at the end of the meeting, is that you don't want to start with tax planning. First, understand your financial goals, build your projections, understand your current situation. So go in this direction from left to right. Before you like to have your financial goals articulated before you go into the portfolio construction, and you would like to do tax planning only after you have a portfolio constructed, because all these probabilities, Monte Carlo simulation results, they really depend on like what portfolio you would like to have. And your portfolio depends on the financial goals. So there's a lot of dependencies here. So you would like to go from left to right. All right, so that was a great conversation. So thank you everyone for joining us. If you have questions, you can reach out to us over email and just in our community. So have a good day and enjoy your weekend.
All right, thank you very much.
Mm-hmm.